must have had some hypothesis about the environment and about what needed to change. Has that evolved or has that changed as a result of any of the disruption we've seen over the last couple of years?
What initially started as kind of when we got started, what started as a unclear market has now become a people trying to figure out what's next market in terms of how they apply software to their businesses. So we found that the number of folks who now believe that they need to do something different to bring down the cost of origination and ultimately sort of challenge what we've done over the last 10, 20 years in mortgage has dramatically increased.
The real root of it goes back to the mission part, which is consumers and communities are very uncomfortable to uncertain about where they really can afford, where they can go. It's clamping down on a lot of things, not just this past couple of years, but over the longer term, where there is still a significant amount of housing need in the country. And you put that into a mindset where it can be done by large companies, it can be done by large banks, but real estate to some core is still a community product.
What have the drivers been on the demand side? Maybe say a little more about what you're focused on and what has evolved.
Like the obvious one is the fact that mortgage rates have gone from 3% to almost 7%. And, housing affordability has basically gone through the roof, right? And that's really slowed down, origination volumes are probably about a third of where they were in late 2021. So like the volumes coming through the business are much, much lower. But also on the demand side, things have changed pretty dramatically. The real challenge is going to be, there was this entire infrastructure ecosystem, whatever you guys like to call it, that was built on sort of feeding demand from all these regional and even mid-sized and larger banks, but feeding them with product. Now they don't want the product. They don't know if they can have the product because there may be coming changes in capital rules. And the real question is like, how does that product get distributed into demand?
What gap is being filled by this aggregation model that you're describing?
I think the real gap is that it's very difficult for the investor base, to face off against a large number of small originators. Mm-hmm. Just like it's very difficult for small originators to kind of find a way to distribute their product.
Why is the level of aggregation possible? Why is the level of interaction with the borrower, the level of interaction with your distribution partners? What about technology has evolved that makes that all possible now that wasn't possible 5 years, 10 years ago?
One, I think, there are technological shifts and then there are like consumer behavior shifts, meaning on the software side, we've just seen a big proliferation of, for us specifically, for FinTech infrastructure. So now it's much more common to rely on existing infrastructure versus buying necessarily, versus building from the ground up. So I think overall, there's much more connectivity that allows us to sort of bring all of the pieces required to execute a transaction, whether that's third-party verifications, even credit, document processing. And so being able to do all of that and really deliver it at the infrastructure layer and have our customers integrate that much more quickly is much easier now than it would have been 5, 10 years ago.
To the extent that there are individual component pieces of technology that have been built and exist, but bringing them all together and then making that really how humbly you define a loan does command that type of presence when we think about the need for it in the marketplace. And the Achilles heel inside of mortgage companies, if I could offer it to you as an opinion, is the amount of change management that they actually go through and resistance to change that they go through when they have one component versus it all fits together is enormous, which is why a lot of the companies that offer singular products, respectfully, have a difficult time getting the adoption rate to where they can actually take the next step. The technology is probably great, but nobody's going to use it if it doesn't fit the rest of the components as we think about it.
Who's the ideal partner, distribution partner of Pylon?
And so I think when people think like, okay, embedded mortgage, what does that actually look like? They immediately think point of sale, usually the sort of marketplace angle. Turns out that mortgage credit actually makes sense to offer in a variety of places, particularly as companies in this environment are becoming more multi-product and trying to increase revenues and sort of ultimately drive better results on their core product.
What do we expect in the next couple of years? Is there, with some of the catalysts we've seen across interest rates, geopolitics, regional bank failures, do we think we've reached a new normal? Do we think there's more tectonic shifts in the future?
So there's definitely a lot of pain to come in the mortgage industry. There's probably still a lot of just people who haven't a lot of originators who have not come to terms with the fact that they're not going to be making profits anytime soon, and have to either cut costs and merge with other originators or go out of business. So I think you'll probably see continued consolidation and pain on the origination side. And the other big one obviously is housing supply. A lot of the government programs, a lot of the things we do are based on stimulating demand for homes, which often just raises prices. And another thing to solve is really to focus over the next couple of decades on increasing supply. Increasing supply is what lowers home prices and makes them more affordable.
Bob, any thoughts on whether the shifts we've seen over the last couple of years, particularly in the context of many of your customers, which are small banks or independent mortgage banks, how do you think about their future?
Everybody says there's going to be consolidation of banks, and there should be. And there should be consolidation of real estate firms, and there should be consolidation of mortgage companies. But I don't see that fundamentally changing the fact that there's $13 trillion of debt, and it should be going a little bit higher as we think about it from a standpoint of where we could serve them better.
But Trent, from a positive perspective, what are you most excited about?
The way that mortgage tech stacks work today, it's like 10 to 20 SaaS products duct taped together, trying to do things, trying to coordinate with one another. And we've made a lot of progress on open infrastructure over the last 5 to 10 years. But frankly, it's somewhat unnecessary. And so we think that there's going to be a mass consolidation. And obviously, we're very biased when we say that, but that you should only really have to integrate with one, maybe a few products to go and stand up mortgage. And that will drive a lot of efficiency at the production level as well, not bouncing from system to system.